Imagine you're scrolling through Instagram and YouTube and you see a video saying, invest consistently and you'll have 5 crores in 30 years. Sounds like a dream, right? But have you ever stopped to ask, what will that 5 crores be in 30 years? Spoiler alert, it might not be as much as you think. Welcome to today's video. We will uncover the real story behind inflation and how it impacts not just your daily life but also your investments. So let's get started. Inflation in simple term means rising prices. The same 100 rupees that used to fill your grocery bag a decade ago barely buys few items today. It's not just about numbers, it's about the shrinking power of your money. For instance, a movie ticket that costed 50 rupees in 2000 now costs around 500 in major cities. That's inflation in action. It's why saving money under your mattress is no longer a viable strategy. Inflation impacts every aspect of our lives. From our groceries to housing, from our transportation to education and healthcare, inflation hits it all equally. A 2 BHK flat in Bangalore that rented for 20,000 a decade ago now costs upwards of 40,000. Fuel prices fluctuate, but the general trend is upwards. A liter of petrol that costed 50 bucks in 2010 now costs over 100 rupees in many cities. And this is just in 10-15 years of time that fuel inflation has doubled. This rising cost of living is the silent squeeze on our wallets, making it harder to save and invest. Speaking of which, inflation can be understood in two ways. One is the demand pull inflation. Imagine the latest iPhone launch. Everyone wants it, but the supply is limited. This increases demand, pushing the price up. The same logic applies to essentials like real estate in popular cities. Another is cost push inflation. Picture a drought that ruined crops. This raises the price of grains and vegetables. Similarly, when fuel prices go up, transportation costs rise and so does the price of every essential goods. In India, the government uses primarily two indices to measure inflation. One, wholesale price index, which tracks price changes at the wholesale level. It's like checking how much wholesalers pay for goods in bulk. While useful, it doesn't directly reflect consumer experience. 2. Consumer price index. This is the one that matters to us. It tracks the price of items like grocery, rent, and utilities. For example, the CPI might show that the cost of food has increased by 7% in the last year. Moving forward, the inflation rate that the RBI targets is about 4 to 6%, which is an average across the country. But in real terms, it's not the same everywhere, and here's where inflation gets nuanced. In rural areas, inflation might seem lower because basic commodity dominates the basket. But rural incomes grow slower, making even smaller price hikes significant. Living in Mumbai, a tier 1 city, is vastly different from living in Ujjain, which is a tier 3 town. For instance, while a cup of tea in Mumbai can cost 25, of course, we're talking about street vendors, not Starbucks and the likes, the same cup in Mysore might still cost 10 rupees. Even within urban areas, inflation affects different demographics uniquely. For a tech worker, rising rents and transportation costs might hurt the most, while for a retiree, medical expenses are the biggest pain point. In a 2 BHK in Bangalore's Whitefield area costs around 50,000 per month. In tier 2 cities like Jaipur, a similar apartment might cost just 15,000. You might get to watch a movie in PVR at 250 in a tier 3 city, but not in Mumbai or Bangalore. To watch the same movie in the same multiplex, you might have to spend over 500 rupees. So, inflation not only drains your pocket faster for the same things in a different city, it also takes a dig at your savings and investments and quietly erodes your wealth. So, coming back to the 5 crore dream. If you are aiming for 5 crores in 15 years, inflation might make it feel like approximately 1 crore in today's terms in tier 1 cities. Meanwhile, in tier 3 cities, it might retain the purchasing power of 2.5 crores. So, what will be your real returns? Say your investments grows at 10% annually, but inflation is 6%. Your real return is only 4%. Over time, this gap can significantly shrink the value of your wealth. For instance, if you save 10 lakhs today for your child's education, in 15 years, that amount might cover only half the cost of a decent college degree. To avoid the effects of inflation in your life, here are 4 things that can keep you stay ahead. 1. High growth investments. Stay away from FDs. It barely covers inflation. Invest in Indian equities, stocks with good, strong fundamentals. Invest in global growth equity and also dollar appreciation through US market exposure. You can also consider crypto investments. I know it's tricky, but invest carefully. It's highly volatile and simply stick to blue chip like Bitcoin after understanding the risk involved. Definitely avoid all the meme coins and the hype around it. Of course, invest by understanding macroeconomics factor, which is very, very important. 2. Invest in real and physical assets. Of course, know the location. Real estate in growing tier 2 cities can be a good hedge against inflation. 3. Start early and reinvest in investment to maximize growth and experience the power of compounding. And finally, 4. Stay educated. Inflation and markets are dynamic. Regularly update your financial knowledge. Inflation is the silent thief that impacts every rupee you earn, save, and invest. But with the right strategies, you can stay ahead. Remember, it's not how much money you make, but how much purchasing power you retain. That's it from me. I'm Nikhil Varghese. If you like this video, give it a thumbs up and share it with someone who needs to hear this. And also subscribe to learn how to make your finances less tricky with FinNiki.